You're watching Savvy Investing Hub, where smart investors stay one step ahead.
We've all bought gas at the pump. You see the price go up and down every time you drive by. Now, imagine you're in charge of a whole fleet of vehicles. Suddenly, fuel prices matter. A lot. What if you could lock in the price today just in case it jumps tomorrow? If you can picture that, you already understand the basics of options trading. Let me show you how it works. In this video, I'm going to show you how to understand options using one simple example that we can all understand: buying and selling fuel. Hi, I'm Mark with Savvy Investing Hub. We're here to help you learn how to build wealth, even if you've only got a few minutes a day. By the end of this video, you'll know how to use options to protect your money, generate income, and maybe even get paid just to wait. Meet Frank and Joe. Frank owns a delivery business. His trucks burn a lot of fuel. Fuel prices change constantly, and that can wreck his budget. So, Frank wants to lock in prices ahead of time. Joe is a fuel supplier. He's fine selling at today's price, even if fuel goes up. He just wants steady sales. Frank meets Joe for coffee, and he says, "Joe, I'm worried fuel prices might go up. I would like to lock in my cost if possible." Joe replies, "I tell you what, Frank, if you pay me $10 today, I'll give you the option to buy 100 gallons of fuel at $3 a gallon anytime in the next 3 months." Frank is paying Joe $10 for the right to buy 100 gallons of fuel at $3 within 3 months. If fuel goes up to $3.50 a gallon, he saves $50. That's 50 cents a gallon times 100 gallons equals $50. If fuel drops to $2.75 a gallon, he would let the contract expire and just pay the $2.75 per gallon. He would be out the $10 that he spent on the contract, but he protected himself from a possible spike in fuel prices. A call option is an option to buy an item or a commodity. Frank is buying or paying a premium for the right to buy the fuel at the agreed upon or strike price. Joe is selling or getting paid to give Frank the opportunity to buy the fuel at the agreed upon price, if he chooses to do so. Joe is getting paid because he is taking on risk. He has obligated himself to sell the fuel at the agreed upon price if Frank decides to exercise his option. Joe says, "Frank, I'm fine selling you the fuel at $3 per gallon. Just pay me $10 now, and I promise to do so if you decide that that's what you want to do." Joe is paid $10 to potentially sell 100 gallons of fuel at $3 per gallon. No matter what happens, Joe keeps the $10 for the contract. If fuel stays below $3 per gallon, Joe keeps the premium. If fuel goes higher, Joe still keeps the premium, but has to sell the 100 gallons to Frank at $3 per gallon. Joe gives up some upside potential for guaranteed income. No matter what happens, he gets to keep the $10. Joe and Frank have just illustrated the buying and selling of a call option. Again, a call option is a contract built around buying an asset or a commodity. Someone pays for the option to buy an asset at a predetermined price. The other side of this transaction is the seller of the option. They are obligated to sell the commodity at the predetermined or strike price if the buyer of the option chooses to exercise their option. The buyer of the call has the right to do something if they choose. The seller of the call has the obligation to do something if the buyer of the call wants to. A few months later, Joe stops by the fuel depot. Frank says, "Joe, I've got 100 gallons of fuel stored, but I'm worried prices are going to drop." Joe replies, "Frank, let's make a deal. You pay me $10 now, and I promise you I'll buy the fuel from you for $3 per gallon anytime in the next month. I'll take that risk. Frank buys the right to sell Joe fuel at $3 per gallon. If prices drop to $2.50 per gallon, Frank still gets to sell at $3 per gallon. If prices rise, he would let the contract expire. He would be out the $10, but he would have protected himself from a potential price fall. A put option is an option to sell. In this instance, Frank is the buyer of the option to sell, and Joe is the seller of the option. Frank says, "That's a good deal. If prices go up, I'm okay selling at $3 a gallon. Here's $10. It's worth it to me to protect myself if prices fall." Joe agrees to buy at $3 a gallon if Frank wants to sell. If prices stay above $3 a gallon, Joe would keep the $10 and the contract would expire. If prices were to drop, Joe would be obligated to buy at $3 per gallon, but he got $10 for taking the risk. Selling a put is getting paid to take on the risk of possibly being assigned a stock or a commodity at a predetermined price. Buying a put is the right to sell at a predetermined price if I want to. Now there's one more piece of this options puzzle that I want you to understand, and it's a big one. It's called time decay. Options don't last forever. Every contract has an expiration date, and the closer it gets, the less valuable that option becomes, even if the price of the underlying asset doesn't move. This gradual loss of value is called time decay, or it's referred to as theta. But here's something that most people miss. Time decay only matters if you're planning to sell or buy back the option before expiration. If you plan to hold the contract all the way to the end and either use it or let it expire, then time decay isn't your problem. It only affects you if you're trying to sell a contract that you bought or buy back a contract that you sold. Most of the option strategies that we use and teach here at Savvy Investing Hub revolve around passive income. So we are normally selling an option and letting it expire. But for more complicated option strategies, time decay could be a factor. So I don't want to get too deep in the weeds on time decay, but since it's a part of options trading and strategy, I wanted to introduce the concept here. To illustrate the concept, let's bring Frank and Joe back into it. Going back to our original scenario. Frank pays Joe $10 for the right to buy 100 gallons of fuel at $3 per gallon, just in case prices spike. A few days go by and the price of fuel isn't moving. Frank starts to think, you know what? I don't think the fuel price is going to rise as much as I thought it was. So, Frank decides to try to sell the option to another delivery company. Frank calls one of his friends and he says, "How would you like to protect yourself from rising gas prices? I have a contract that will allow you to buy fuel from Joe at $3 per gallon anytime by the end of the month." His friend responds that he is interested, but that there are only 15 days left till the end of the month, and fuel prices really haven't moved that much. He says it's only worth $5 to me. Frank agrees and sells his contract to his friend for $5. He's lost $5, but that's better than losing 10. That's time decay. The value of the option went down not because of price movement, but because there's less time left for something to happen. The closer you get to expiration, the less likely the market is to move enough to justify using the option, and that makes the option worth less. Time decay is subtle but powerful. If you're buying options, you're racing the clock. If you're selling options, the clock is working for you. And that's why many professional traders choose to be sellers. They get paid even if nothing happens. There's no limit to the number of times a contract can be bought and sold. The only limiting factor is the expiration date. Joe could buy from Frank, but then sell to Jill, who could then sell to Jack, and so on, until the option expires. Options trading can seem complicated because there can be so many different combinations between buy and sell, call and put options. But every strategy, no matter how fancy, is built on four simple building blocks in different combinations. Buy a call, sell a call, buy a put, or sell a put. If you can understand these, you'll understand the rest. Thanks for watching. If this helped you finally make sense of options trading, do me a favor. Hit like and subscribe, and share this with someone who's still stuck in chart confusion. You have questions? Drop them in the comments. I read every one. And if you want more simple, no-fluff investing strategies that respect your time, hit the bell icon so you don't miss what's coming next. I'm Mark with Savvy Investing Hub, helping you build wealth in your spare time.